Hello, I am Sensei Kevlar, and welcome back to the Dojo. Congratulations on making it this far. Today we are doing Defense Against the Dark Arts, and I want to just remind you that the whole reason that I am teaching you this is so that you can see a path through to your own opportunities, through to your own profit. What I'm about to show you is a deviation from that path. It's a way that people do things in order to make money, and I don't suggest it. But I would be remiss if I did not show you what it is that's going on here. So today I'm going to break down how derivatives work and how derivative markets work. And I'm going to show you both the downside of them and some potential ways of looking at upsides to them. And I hope that you are not tempted to deviate from what it is that I've taught you so far in terms of making a plan, because I intend to make the case that I can show you exactly the same way to do it through planning without using these tools. So let's get started. We're going to break down a little bit of math to start. The way to look at this is that derivatives are a contract. The way that contracts work is that people make agreements with each other. In a contract, you have two sides of an agreement. Let's use the example of a commodity where, like, a farmer has some cows, and what he wants to do is he wants to sell his milk. And what he's going to do is he's going to sell it by the thousands of gallons or whatever, right? And so he's going to make a contract, and what he's going to do is he's going to look at the market, and he's going to say, well, in colder months, the price of milk tends to go up, because, people have a harder time, and in hotter months, the cows are more active, and they produce more milk, so the price tends to go down. So during the winter months, the price goes all the way up to $100. And what I want to do is, we've got basically what looks like an order book here, which is that, I've got my milk, and I'm trying to sell it at $100, and then there's people above me that are selling it for more, and I'm trying to get ahead of them in the market here. This is our order book on the milk. Okay. What we're trying to do is we're trying to say, what I want to do is I want to lock in this price, because over here we've got buyers, and they're willing to pay, 98, 97, 96 is how the order books look in an exchange. Now you have this situation here, and what people want to do is they want to lock in this price in the future, because what they're doing is they're looking ahead in time. And they're saying, well, I foresee a time when this is going to go down. This is going to go down to 80 and 70 and 60 during the winter months, or during the summer months. And here we are in the winter months, and I want to lock in this price, or this price, 98 or whatever it is. Let's say that we can get, we can get somebody here who's at 99. Let's say we can even get a buyer at 100, and then this disappears from our order books. Okay. What we're doing is we're saying, okay, well, if you're willing to buy milk at, at this price right here, what I want to do is I want to lock in a contract with you. I'm going to lock in a contract for 10 of these at $100, except I want to do it in a, I want to have a delivery date 6 months in the future. Okay. Now, this person is saying, well, I need to lock in my costs. I have stores, because this here's our distributor, and this here's our farmer, right? Okay. He's saying I need to lock in my costs. If I can lock in my costs at $100 for 1,000 gallons of milk for the next 6 months, well, that's a good deal for me, so I'm going to take that deal. So I'm going to say 100 times 10 at 6 months in the future, right? And so what this does is this allows us to create a contract that is mutually beneficial for both of these people. And both of these people lock in their price, and they have some delivery date in the future, and they agree to this contract, and they both sign this contract in the future. Okay? And they create this contract, okay? What happens, though, is then the price of milk inevitably changes sometime in the future, right? Let's say that, in fact, the price of milk goes up to 101 and, goes as high as 110, right? Okay, and over here we've got farmers who are happily selling it at 111 and 112 and 113. Okay. Well, this guy's still locked into his 100 price. He's still locked into his 100 price. Now, he's not very happy about this because he's lost out on potentially $10 worth of value. He's potentially very happy about this because he's now, buying milk for $10 less than the market price. Okay? So what we said about this contract is, for this person, this contract is negative $10. And for this person, this contract is positive $10. Okay? We can say that because the difference in price between what it is that they're actually getting and what they can turn around and sell it for is that amount. Okay? What they can then do is they can sell this contract itself. They can sell this contract itself, and they might want to do that because they might not want to wait 6 months in the future to realize this difference. And somebody who's willing to pay $105 for this contract, well, that gives him a difference of now he's not negative $10, he's net negative $5, and that gives him the $5 that he wants right now. And the person on the other side can effectively turn that around for, 3 months in the future for plus $5, because that's the difference on what they made. What we're saying here is that this contract becomes the tradable asset, and it in and of itself has a price which is determined by the market that it's derived from. The reason that that's true is because if the contract is valid and delivered, then you can turn around and do that thing on that market at the difference of whatever the cost is, plus or minus whatever the cost of the market price is, and make that difference in arbitrage. This contract is what we call a derivative because it derives its value from the underlying market. More specifically, this type of contract is called a future because it has a delivery that's in the future. And as that contract approaches that delivery date, we can speculate that it's becoming more and more worth what it actually is worth, right? The difference is more and more closer to what the actual difference is, as people speculate it closer to the close of the contract, until the contract closes and the prices merge. Because nobody's going to pay a difference when you can just get the real asset at that price right now, when the thing's going to deliver right now. What we can do with this is we can then create these contracts in a speculative fashion and do something clever like actually forego delivery, or make deliver settlement of the delivery internal, which means you don't actually get the asset at the delivery date. You just carry over the contract onto a new contract. Little silly tricks of contracts, right? What I'm talking about is I'm talking about assets on exchanges that are derivatives. They're called futures. Probably heard of them. And they have a price. And the way that they work is that you're allowed to trade them, and what you're doing is you're just taking up the other side of the bet. If you're taking up the positive side, then you're taking up the positive side against somebody else who is taking up the negative side of the bet. Okay. Now, this in and of itself is fine, and there's not a whole lot of point unless you're speculating on future prices. And that's exactly what they're doing. But there's something more happening here. In addition to being able to arbitrarily just create as many of these as you want without actually having a backing asset, which makes these very liquid. You don't need a backing asset because you never actually do the delivery. In addition to that, you can do something like apply leverage, which is where you say that you're going to spend more than you actually have. And here's the way that this works, is it works like, for instance, on a lending principle, where if I put 1 Bitcoin in, and I want to get 20 leverage on that. Okay. What somebody has to do is somebody on the other side then has to lend me 19 Bitcoin. Okay. What that means is that my 1 Bitcoin plus this 19 Bitcoin equals 20 Bitcoin. And instead of 1 Bitcoin worth of value, I can now buy, like I have, 20 Bitcoin worth of value. But what that means is that things now move 20 times as fast. Okay? Because if I lose, if Bitcoin, the value of Bitcoin starts going down and I lose 1 Bitcoin worth of value, which is a lot easier to do when you have 20 of them, right? That's only 1/20th the percent of the value that has to be lost. Versus if you have 1 Bitcoin, then 100% of the value has to be lost. Okay? So 1/20th, well, that's 5%. So if Bitcoin now goes down 5%, well, I just lost my 1 Bitcoin. Bitcoin goes down 5% all the time. This is called leverage, and what they're doing is they're enticing you to pay a fee to this guy right here for the honor of losing your money when it goes down 5%. All your money, your whole Bitcoin. Even though it only went down 5%. Why? Because everything is multiplied by 20x. Why? Because you're playing with 20 Bitcoin. Okay? And this is the power of derivatives, is you can just, do funny money, and you can do all these silly things. It's other things, options work the same way, where they give you leverage. Anytime you see the word leverage, what you're doing is you're paying for the privilege of 20xing your initial position. It's the same thing. Don't believe me? Try making a plan and then see that plan work with leverage, 20x leverage, and then see if that same exact plan works exactly the same way if you lose exactly the same amount if you just start with 20x the starting position. The reason that this works is because that's what you're doing. You're really just, buying 20 Bitcoin worth rather than 1 Bitcoin worth. You're paying a fee to be lent the money. You're paying to leverage the money to get your profit, get your portfolio destroyed as soon as it goes down 5%. You're paying money here, you're paying money here. This is how traders get wrecked. You ever hear of a margin call? That's when this thing goes down 5% and you lose all your money. They recall your 1 Bitcoin and it's gone. Because the remaining 19% has to go back to paying his loan back. Don't do this. If you think that leverage is a good thing and that you can use planning to make leverage work for you, well, try planning with 20 times more at the start. You'll find it works identically and you don't need to pay for it. You'll find it works identically and you don't need to pay for it. Planning means you can avoid leverage entirely because it's exactly the same as just planning with larger amounts. And losing those larger amounts. It doesn't work as a strategy. It looks good to the naive trader. It looks good to someone who's trying to do really short. Oh, I know the market's going to go down. It looks real good. It looks real attractive. And it eats people alive when the market goes against them. And what I'm telling you is that if you play this game long enough, the market will go against you. I've seen it happen. I've seen it happen in every direction. Up, down, sideways. People lose their portfolios this way. Don't do it. Now, it isn't to say that this is all bad. In fact, if we're looking at this the right way, of course, the obvious place to be is over here. This is where you make your money. You want to make your money in leverage trading? Be the lender. Because this guy is sitting pretty and not losing his money when this guy loses this, assuming you're working on a good exchange. Now, that's not to say that every exchange is good. Some of the exchanges, they actually do get, nasty margin calls and end up socializing losses and stuff like that. It doesn't happen very often, and generally, these are the guys who get impacted when it does. But for the most part, this is a pretty safe bet. And I can tell you, back when Polnix used to do lending, I used to make a lot of money. Getting 3 and 5 and 7% a day. Because people would pay that to borrow the coins for 3 days. They'd pay 3% on Dogecoin, and they'd pay 3% on clams, and they'd pay 3% on just about anything. Bitcoin. 3% a day guaranteed just for sitting there and doing nothing. This is the side you should be on. Now, how does all of this correlate to what it is we're actually doing, besides to say, don't do it? Well, let's take a look at the charts. I'm going to show you a technique for doing comparison trading and why this is useful. And now, ETH, BTC, USD. what we're going to do is we're going to pull up a BTC USD chart. And this particular chart happens to be from Bitfinex. But what you'll notice is that other exchanges have different prices. And what we can do is we can take a look at what the future market is doing versus the actual market that it's derived from. And maybe we can glean a little bit of information. So what I'm going to do is I'm going to hit compare to add a symbol. I'm going to type BTC USD and I'm going to look at the 3-month futures. Okay. Now, sorry, let me change this to BTC USD from OKCoin. There we go. Okay. And then what I'm going to do is I'm going to bring in the BTC USD 3-month. So these are there we go. Okay. These are okay, so now we need to adjust this before we go any further. Go to settings and go to scales. And unclick. Where is it? No. It's this one right here. Pin to right. Okay. So what I did there is, normally this only scales the main chart. And what I wanted to do is I wanted to scale the futures chart that I've now overlaid. And you can see it right here. The other thing I'm going to do is I'm going to make it a little bit easier to see by making it a line. Okay. Now, what we're looking at is we're looking at the futures, which have an expiration of every 3 months. And every 3 months, they just cycle over to the next set of 3-month futures. Okay. And in the past, what we can see is that there's been deviation from the future, from the price, okay? And the price deviation will generally give us a good idea of what the trend looks like. If you look a little bit closer here, in times past when the futures market has pulled away, has deviated from it, you tend to see a correlation, okay? In times past when it's deviated from it, you tend to see a correlation. Here we see futures racing ahead of the game, and then here we see futures pulling on and down ahead of the actual motion. But then here we see them reverse again, showing that we have potential for doing up again. And then, sure enough, as soon as futures went above our normal price chart, well, guess what? The market went up again. Okay? So, there's strong correlation here based upon market sentiment and the futures market and what the charts will do next, as it were. And what you can do is you can come here and look at the correlations. Look at all the times. Look, man, it's below. It's below the chart, right? And here we didn't see it pop above. So this is an anti-correlation. But that's the whole point of the technical analysis, is you can go back and see what the correlation on this is, along with when this is this correlated with this and with this and with this and all of these indicators, and this becomes yet another indicator. Okay? You can bring in yet a third data point, right? Let's bring in, so I'm looking at the OKCoin. Let's bring in BTC USD from Coinbase. Okay? And again, make sure that this is pinned to the scale on the right side. And then we'll change it to look like another piece of our signal. And we'll make it orange. Okay. And here, look at this. Look at these deviations, right? These deviations are highly correlated. The futures followed Coinbase better than Coinbase did, or better than the actual OKCoin did. Okay, so by studying two or more charts together and looking for correlations within those charts, you can find more signals, you can find more markets and how they're correlated, and you can look for patterns in those correlations and in those deviations. Same way that MACD, RSI, and the bottom indicators are correlated. Now, these aren't necessarily as strong a signal. A lot of the time, these just don't signal in the way that you expect them to. But generally, when you have some sort of really strong signal in the past, they've been pretty interesting to look at as a point of speculation. Because what happens is that futures will sometimes shoot way ahead of this. Sometimes they'll dip way below it, right? And these are often correlated with motions in the market in a lot of different ways, right? Here, the separation is getting bigger and bigger. Well, as the separation is getting bigger and bigger, the market is going up and up. Okay, and here, as the separation is closing, as the line is coming back down, the market is going down again. Comparing markets and just bringing in more and more and more markets will give you a better understanding of how these markets are related to each other. Let's make sure that we line, we'll make it green, and it needs to be pinned to the right. Okay. You can also do this with other markets. You can, look at the correlations or the anti-correlations of Bitcoin versus Ethereum, against the dollar. It's a little bit more of a black art because you basically have to compare your scales in a lot of ways. You have to flub your scales. So what that would look like, and this is more of a black art here that I'm doing, ETH/USD, okay, is without doing the scales, we can see a lot of correlation between these. In times when the markets are generally going down, they're generally going down together. In times when the markets are generally going up, they're generally going up together. But what we can also see is that the Bitcoin market and the Bitcoin bull run very much preceded the Ethereum bull run. That is a signal in and of itself. Bitcoin going on a bull run like this is oftentimes a predecessor to other coins going on a bull run. So this is another type of signal. This is another type of correlation. Okay? All of these markets are valid data. All of these markets are valid to analyze, especially when you're comparing time signals like this, right? You can see that these line up pretty well, but look at the time differences here. While this market is basically going sideways, Bitcoin is signaling the bull run ahead. You could have been buying Ethereum during Bitcoin's bull run right here. Could have been buying Ethereum right here while Bitcoin does this. And Ethereum is going sideways. These are heavily correlated markets. Finding the correlation between them will increase your understanding of how these markets are correlated, and it will help you to optimize your plans. It will help you to understand that a lot of these markets are very heavily manipulated. A lot of these markets have just, a lot of these things are just moving in order to put them where institutional investors want them in order to do allocation, in order to do distribution. That's what this is, okay? This is, all of this allocation, all of this, bump, 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 right? Pushing it higher, bump, bump, bump. The bull run, that was people getting out. This is a lot of getting out. There's going to be a lot of getting in down here. There's going to be a lot of sideways motion. It's going to, trail along for a while. Do one of these. We're going to see some bumps in that sideways motion. You want to be accumulating. You want to be studying these markets. You want to be figuring out what all of the possible signals are that you should be paying attention to, subscribing to all of the news, watching all of the futures closing. There's actually OK coin market closing, future market closing. There's lots of news about it, but where's the damn countdown timer? Here we go. Get jump bucks. Okay. On yeah, OK Coin is going to have one of those big closings in 6 days, it looks like. Right? What this will tell you is generally you have futures that are closing weekly, futures that are closing every 2 weeks, and then futures that are closing every 3 months. And then I don't think we're at the equinox. So when the 3 months, the 2 weeks, and the 1 week all close on the same day, you generally see a lot of price action. You generally see a lot of, anytime that a closing occurs, any closing day, you'll generally see a lot of manipulation. You'll generally see, the futures market has to correlate exactly with the price of Bitcoin right at the moment of closing. Otherwise, people are just making free money at the point of closing. And so you'll generally see a lot of motion. You'll generally see a lot of price action, paying attention to this number right here. On the days when this goes to 0, these signals are very interesting. Just watching these markets is interesting. Being aware of how the whales leverage this, being aware of the sentiment of shorts and longs in the market and the size of each of them, that's another signal. It doesn't have to be price action. It can be amounts, can be volumes. The volume of shorts versus longs, that's a signal. That's going to tell you a lot. That's going to tell you a lot about the market sentiment. All of this is related to market sentiment, and paying attention to the market sentiment and finding the correlations in the market sentiment is what makes you the trader that you are. It's what makes you much more aware of how the market changes and the things that indicate change. Because if you look at what's happening right here in the market, we're seeing signals, we're seeing indicators that in the past have signaled a bull run. And what that does is that's going to signal sentiment, that's going to signal bots to buy, that's going to signal investors to get back in, investors who got out up here. It's going to signal them that, hey, we're down here. This is the moment you've been waiting for. You've been holding out this whole time. We're finally there. Looking for the sentiment to change. What we're looking for is longs to become greater than shorts. We're looking for volume to keep increasing and for these spikes to get bigger. We're looking for indicators that will indicate what it is that the market will do next. And every aspect of these markets is correlated, and studying every aspect of these correlations is crucial. So your homework for the weekend is to go and study more charts at the same time. Because what we're going to be doing next week is we're going to be putting this all into very real action. We're going to be automating portfolios in live real time, and if you want to play along, you're invited. We're going to be making plans and watching them execute and talking about ways to optimize them in real markets with real money. And your portfolio is up, it's on you to figure out what plans you want to make and how you're going to allocate your portfolio. And I promise you, this is one of those things where the more time you put into it, the more charts you study, the more indicators you look at, the more correlations you find between markets, between indicators, between all of the different things that go on in these markets, the news that goes back that corresponds with these times, the news that corresponds with these times and these times. The more you are in the market, time in the market, not timing the market, the more money you will find you can make for yourself. But only if you create the opportunities when these markets signal. If you sit there on the sidelines and say, well, I'm, not going to buy because I don't have a plan, or the plan's just, it's never going to make you money. If you don't sit here and fearlessly buy when the RSI does this, and the MACD does this, and the FIX does this, with a plan in place for when it does this, because it still can do this. Don't get me wrong. Don't hear that I'm saying that it can only go up from here. It's not the case. You need a plan for when it comes down to here. But if you create those opportunities for yourself and you spend the time in the market when those opportunities do come around, you can create much profit for yourself. So I invite you to do as much studying as you can of these charts, because we are in a situation where the opportunities are getting ready to create themselves. And next week is going to be a really big week for those who want to start automating their portfolio and planning their trade and trading the plan. And that is the way of the trader. I hope that you have enjoyed the instructional aspect of the dojo, and I really look forward to moving into the actual execution phase next week. I will see you all on Monday. Please bring your plans and get ready to do this for real. Thank you very much.